we were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you could build on. I am your host, Kevin Amolsch. I'm very excited about this podcast because we not only help real estate investors, but we help real estate educators as well. So if you're providing content to investors or you're an investor yourself, this is the podcast for you. As you know, we do a very special podcast once a quarter, the Market Pulse podcast with special guest host, I should say, Mr. Sean Bloomquist. And then as always, the one, the only Mike Jacka is going to go over some details about the Minneapolis or Twin Cities, let's call it, data and market so we can make better investing decisions. So with that, let's go ahead and get started, Mike. I mean, let's talk about the macro level first. I want to get your opinion on like the interest rates higher for longer. Like this is what's in the news, right?
Right.
We're supposed to see, we're told 3 rate cuts this year, 2024, and the market's built in 6 cuts. And we talked about that last quarter, I think.
Yep.
And now we're expecting maybe no cuts. And I'm hearing some people say, we might need to increase rates. Now, clearly, I don't think that will happen, but gosh, how do you unpackage this?
Well, boy, I know I don't have the world's greatest memory, but I'm pretty sure I remember you and I talking about this on the last podcast.
Yeah.
Where you and I both laughed at the idea that they were going to be actually doing any price or interest rate cuts. I remember vividly the fact that you and I both even said that everyone was saying that they pencil them in, which means it's guaranteed. And we're like, I didn't hear that. And based on what we're seeing in the economy, that is not going to happen. No, so I would have to say right now, you and I are vindicated on our opinions at that.
Yeah,
time.
Exactly. And as we get closer to the election, like I just can't see it happening.
Well, and I even said, if I remember right, I mean, I'd have to go back and watch the podcast. I've had so many different conversations with people, but I remember, if it wasn't on yours, I remember saying on somebody else, or maybe even just in a private conversation. I don't remember the exact details, but I remember saying, if anything, we're going to have increases in the interest rate this year. I can't see it not happening unless, and this is the one thing, and we don't want to get much into politics, but because of the politics, they might hold off on rate cuts until after the election. I mean, rate increases until after the election. So that's the best case scenario I can see right now. But if they do and get through the point where there's no increases in rate increases between now and the election, which is only 4 months out, 5 months out. Actually, no, we're in May now, so we're talking about 5 months, 6 months out.
Yeah.
If we don't have any price increases or rate increases by then, I would expect, unless things dramatically change from what we're seeing in the economy, there's going to have to be a couple rate hikes after the election.
Yeah. Gosh, can you even imagine? I don't know that they will go there. That would be, what's going to happen to the stock market if they actually
be tinfoil hat stuff you're talking about?
Yeah, exactly.
Yeah, well, welcome to the tin. Well, look at my hair, right? Obviously, I've been wearing some tinfoils for a while, and I've been proven right almost every time. So I've been really, since the last time, since the great financial crisis, the global financial crisis, I've been studying and following this stuff, and I see things through a different lens than I think most people do.
Yep, I think you and I are looking through the same lens on a lot of it. Sean, what are you thinking? I mean, we know that rates are higher for longer, and it's pretty well accepted at this point. How has your market absorbed those higher rates? Are you still seeing transactions?
Yeah, I mean, you're still seeing transactions, but it's one of the things I read recently was the actual days on market came down just slightly on single family.
Yeah, I was just looking at that.
Down to like 45 days or something like that. But for like condos and townhouses, it's jumped all the way up to like 75 to 80 days on that type of stuff. So, things are still, if it's the same as it's always been. If it's priced right, it's moving, and it's not slowing people down if it's in the right price range. But it's certainly not a frenzy like it was prior to all the rates being up like this. It's not. I mean, people are hesitating. And I think people have a skewed sense of um, how rates are. They're thinking they're extremely high because they were down to what, 2.5 or 3% a
Yeah.
couple of years ago, and they've got this false sense that, oh, they're going to come back down to that. You're going to be waiting forever if you think you're going to come back down to that again. You
Yeah,
know,
unless there's a new strand of COVID or something. I mean,
yeah, I mean, it's going to take, yeah, an act of God for them to come back down to that. So I think people are eventually going to see that, yeah, rates are going to be sticking somewhere in this range of 6 to 8% for quite a while. So if you're going to do something, you got to do it. You know, you can't keep waiting, or you're going to be waiting forever.
I'm so glad you said that. I want to get into Mike. So if you want to pull up your screen, share it with us while I just share with you what I just heard today from a recent survey. 76% of Americans think now is a bad time to buy a house. Is that a staggering number?
Well, yeah. No, I guess I never really thought about it, and I never knew where those numbers ever been. I hadn't heard that before, but I can imagine that. I mean, because yeah, the rates are up, but and well, part of that goes to the fact that I think most people think that there is a crash coming, but we've been thinking that for what, 5 years?
Right.
Yeah, it's been a while.
Well, and there should be, because in reality, economic wise, there was a crash coming in 2019. End of 2019, they changed the rates. They bumped the rates up a little bit in 19, and that shocked the markets. Or I think they started doing it in 18, maybe it was late 18, early 19. But I remember them then pulling the rates back for a while, and it kind of staved off the inevitable. But we all knew in late 2019 there was a market crash coming, and then COVID hit 2 months later.
Yep.
And everything went crazy. So I think we're now maybe starting to see what we were feeling and seeing in 2019. I think we're now seeing that getting a reboot. Except for the fact that we just spent like what, 4 or 6 or 8 or 10 or $20 trillion in the last
Yeah.
year.
Yeah.
I mean, I heard
With more coming.
a shocking stat, one that really floored me. Do you know that 40% of all the money in the United States that's ever been printed were printed in the last 12 months?
Yep. I didn't know that.
Wow.
That's staggering.
Yeah.
You think about it,
It's
it took
staggering.
230 years to print $1 trillion, and now we're printing $1 trillion every 100 days. Every 100 days, they're printing or spending $1 trillion.
Yeah, and I've read a lot recently, actually, but one thing I thought was interesting is that Fannie Mae is going to now start doing HELOCs, and it's been
Yep.
opened up. The government was approved to allocate $3 billion into this program, so people could take out second mortgages, so they could spend more money.
Yep.
And then you're going to tell me that inflation is we're trying to get inflation under control? Like
No.
that will create inflation because people will go out and borrow money and go out and spend it, right? I mean, it seems so obvious to me.
Well, and that's where you have to start following the markets. But if
Yeah,
Kevin, can you give me host privileges so I can
yeah.
share
How do
screen?
I do that? You think
Click
all
on
these
my
times we?
name and then hit and the three little
Oh yeah, yeah,
symbols
yeah. That's
here in the
right.
participants, and then make me host.
Oh, I just hit co-host. Will that work?
Yeah, co-host. Perfect. Okay. There. Now it's giving me the option to share. So I'm going to share the PDF doc. You guys should be seeing
Yep.
this PDF document. Okay. So the median price for April, and this is literally the first time I'm looking at this today, because even as of last week when I was looking at the data, it was still showing March's numbers. So I just re-pulled it up just a little while ago, and it's got the April numbers. And so we did go from last month in March, we were at 366. This month we were up to 385, 250, which is a 4% year over year increase, which is from a price standpoint, that's going in the right trajectory. Right. So things are still going up as appreciation wise, and we're following that annual cycle of we're going back up. So every year you got your peaks and your lows. We're on that rise to the peak, which is normally going to hit us around June, July time, where we're going to peak out for prices and then come back down. But if we keep going at this rate, I predict hitting 400,000 for median price for the Twin Cities by the end of the summer. Right? That's a very, very reasonable expectation. Which gives me to a question I was going to ask you, Sean, since you had made the comment of depends on what price range. What price range are you seeing where the investors having the most success with their flips?
Well, yeah, that's the crazy part is I've been in my mind, my mentality is still that a starter home is, 200 to 250, but that's just not realistic anymore. Starter homes are 300 to 350, and kind of the sweet spot that I'm seeing from investors we're working with is if you've got something in between probably 350 to 500 for a value, those are moving relatively quickly.
For the
Um,
ARV?
yep, things that are below 350. It depends on the area, but um, I mean those obviously are moving a little bit quicker just because they're easier for people to get into. If you're under that 350 range, most people can qualify for something under that, but that sweet spot seems to be 350 to 500 from what I'm seeing.
Okay, that's kind of what I was thinking, and that is a little bit higher than what I was even thinking. Because I was thinking you were going to say probably around 400 or less. So,
I mean, again, it's dependent on the area, but it seems like if it's under 500, it's still moving
well,
pretty
and that
easy.
follows the formula that I was taught 30 years ago, and I've always believed in. This, the sweet spot for investors is about 20% plus or minus the median sale price.
Yep,
So I mean, if we're at almost 400 right now, what's 20% of that's another 80. So
yep,
that brings us up to at 470 to 480. So if you're saying
yep,
500, that's right in line with that formula.
exactly.
So I guess the price doesn't really matter. It literally is just 20% plus or minus of that median price. And that's
Mhm.
going to be that sweet spot. Yep. All right. So, anyways, median price coming in at that 385. One thing that I've been tracking for a while is the showing time values. So if you can see that, we're showing the showing time request, and this is um, so for those who don't understand what showing time is, when the realtors are looking at properties for their clients and they're just going to schedule closings, not closings, sorry, they're going to schedule a showing. There's a company called Showing Time that all the requests go through. So they manage it's independent. I don't know if it's owned by the MLS or whatever, but it's a third party um, company that schedules the showings and manages all those showings for their listings. Well, they track well what price range have the showings requests come from. And so for me, this is a leading indicator as to where the buyers are looking to buy at, what price ranges are looking to buy at. And keep in mind too, though, this is showing us the averages. And I do believe because I've been thinking about this the last couple weeks is the lower price ranges when you because the median price is coming at 330 right now for the showing requests, and that's showing in the average. The average buyer who can only afford a $330,000 property is going to probably look at 50 properties. And so that's going to be shown in there more frequently than somebody that can afford a 500. And those properties, they're probably only looking at 10 properties. So there is a little bit of a skew there, but but if you look at the averages where they're coming out at, as long as they're trending upward, that tells me that the capability of them buying is moving upwards. And if we know that we're running, so like if our median price is coming at 385 and the average show time is coming in at 330, I think that's going to give you a good idea as to where your market's going to be. And based on like we were just talking about with the 20% plus or minus, this is about 10% less than the median price. Right. And so I think if you kind of keep an eye on that, as long as it's staying close to where it is, this is showing us our trend of where we should be going. So this is telling me that the median price should probably next month should probably be going up another 5%, 3.6% increase year over year. right? So that's given me a clue that over the next month or two, we can expect to see that. So what I kind of look at for with the showing time requests is if we start seeing this flattening out, that's telling us what's going to probably happen over the next 60 to 90, 120 days. Because this is what the buyers can qualify for from the lenders.
I
Because think
really
about
like
it
how you
too. The other
describe
thing
that.
is when you go to a lender and get pre-approved, and they come in and say, "Well, you can qualify for up to 300." Do you tell the realtor to look at only up to 300, or do you ask them to look at a little bit higher in hopes to be able to make an offer to bring them down?
Right.
Okay. Well, I also think that's what's happening, and then the buyers are getting frustrated. They can't bring them down because if they're looking at a $330,000 property or $300,000 property, if it just hit the market and it's in good condition, it's going to have multiple offers on it. So if you're trying to bring them down, that's not going to happen. Not in today's environment. But when we start seeing this number start trending down, that's a sign that things are starting to change.
Yeah, I was gonna ask how we use this data, but the way you describe that, Mike, is perfect. So it's kind of a glimpse into the future, I guess you
Yep.
could say.
Of
And
all
then
the
you're
data that we're getting from this data here that we can look at on this is all public information because all you have to do is go to the MLS, or not the MLS, like ours is the Minneapolis Area Association of Realtors. SPAR, which is the St. Paul Area Association of Realtors, also provides it. In any market I've looked at around the country, I can almost always find something very similar to this on the public side, where you don't have to be a member of the association. You don't have to go through any login portals or anything to get to the data. You can find that. So if they're showing this here, now all the rest of the data on this chart in this PDF document, that's all um, trailing indicators. It's what's happened in the future. It's saying April. All right. Well, even here it's saying April, but this is what the buyers are requesting. Everything else is showing us what already happened in the past.
Mhm.
This is what the buyers are requesting now, which means that this is going to start being reflected. If these buyers are buying, that's going to be reflected in the pending and the close sales for May and June when we pick up on that. So it's
And then
giving
to
me a
your
future.
point, your like percent, like what do they actually trade at? So they're looking at $330,000 homes, but what is that going to convert to in a sell?
Well, and that's
And it
where
looks like your next slide.
if we go back in order to find that number, I would have to go back to the median sales price, right, and then go back 2, 3, maybe 4 months.
Mhm.
And if I go back 3 or 4 months, I don't know if you guys can see this on my screen, but if we go back like 2 months, we're looking at February. The median price was coming in at 358. Okay, so the median price is at 358. All right. I actually know what we actually have to do it the other way. I was just thinking that backwards.
Yeah,
If we
you'd
take the
almost
median
have to
price of
look at
385, we have to go back to the showing time and go back to like February, and that was 312. So we're looking at 2 months out. It's coming in at 30,000, so $20,000 more.
Yeah, and where I was going with this, Mike, is if you look at the percent of the transaction traded at compared to what it was listed at, that might give you like an idea of are they going to close at list price, right? Or is it going to be a discount? And I think your next slide, it looks like
Okay.
your next slide is going to go over
So you
that,
see, we've
right?
been at basically at
It's a
100%.
hundred percent. So for those of you that can't see this, it's literally 99.9%.
Right now. Yep.
So if you list it for $100,000, it's going to sell for $100,000 according to what we're looking at right here.
Right. And when we're looking in the lower price ranges, those are going higher than what they're asking. I mean, I was looking at some stuff last week for a property that I was comping out, and asking price, let's see if and I'm going off of memory right now, but list price on one was like at 275, and I think it sold for 309. Another one came in, the asking price was like 280, and it came in around 310. So the ones that have been renovated, the asking prices were under the 300, but the sales prices were all over 300. But vice versa, if you go look at a $500,000 property that sold, its list price was probably 550, and the ones I'm looking at, they're coming in at 550 or at 530. They're not. I'm not seeing the higher price ones come in higher. However, I did see one about 2 months ago where It was listed at 750 and it sold at 780. So I did see one that come in, and I knew that one for sure because the listing agent was a friend and said that they had 30 offers on the property, on that one particular property, but it was also a very unique and desirable place that would bring in more money.
So if
So
we
it
go
did
back to
sell
the
for.
interest rates, like, and I don't want to beat on this because we've already covered it, but you know, there's experts out there that believe if we even have a quarter point reduction in interest rates, it's going to create a frenzy that the market can't really handle. And what you're saying is the 7% rates is kind of where we are right now, and we're listing a house and selling a house for even possibly more than we listed it for. So the market, to my point, or to my question to Sean earlier, the market in Minneapolis really has absorbed or taken on or accepted, maybe is the best word to use, the higher interest rates. So why would the
Yes,
Fed cut? Back to our point, why would the Fed cut if the market is accepting it?
correct. And even the Minneapolis governor, God, I can never pronounce his name, Zakari or something like that. He's even said the buyers are buying and they're borrowing at those rates. So why would we need to cut? If anything, we need to increase it to slow down the economy because
Mhm.
we don't. And he literally even said we don't have high enough unemployment yet. But now we're starting to see the unemployment numbers tick up a little
That's
bit.
right. Yeah, and CPI just came out and it went down a little bit. But so Barbara Cochran, I'm sure all the listeners are familiar with that name. She believes that if rates go down, I think, and fact check me, I'm not sure the exact here, but like a 0.5%, then you'll see a double digit appreciation almost immediately. Like within a quarter of a year, within 3 months, you would see a 10% or higher increase in property value with a 0.5% change in rate. So that would be, if you believe rates might be coming down, now would be a fantastic time to buy, according to her.
Yeah. Well, and buyers don't buy based on interest rates. They don't buy based on purchase price. They buy based on monthly payments. Right. So a quarter rate cut based on what the market is saying they can afford for a monthly payment, that's going to allow them to afford more. So the prices will go up
That's right.
just naturally because we still have such a low inventory. And I did this chart probably 6 months ago. So it's been a while since I've done this analysis. But I kept having a bunch of people ask me, it's like, well, Mike, rates have been going up. How come prices haven't been coming down like they're supposed to?
Right.
And my argument is they have. Are you kidding me? They've come down dramatically from where they would have been if we didn't have the inflation. Right.
That's a good way to
So
look at it. It didn't come down off of its sticker price, but it came down to where it would have been had
right.
those rates
So
not
what I
changed. Yeah.
looked at is because everyone's like, well, the inflation is going up and interest rates are going up. So doesn't that mean that rates should come down or prices should come down? Well, in a normal market, it takes 12 to 18 months for real estate to come down, anyways. Every time interest rates have ever gone up, if you look at it historically, on average, 12 to 18 months for prices to come down. Because what happens is the buyers, they're struggling, but there's still plenty of buyers that can buy. And if the inventory isn't completely out of whack, like inventory went out of whack in 2010 and 11,
Right.
2009, 10, 11. Inventory exploded because there was so much foreclosure and everyone had just gone through a foreclosure and a bankruptcy that nobody could afford to buy. So the only ones that were buying were the investors, and we were buying them at 30 cents on the dollar at that time.
hmm
Right? Well, now things are totally different. And so, anyways, back to the rates, the prices going up, and I ran the numbers and said, okay, at the time, the median price from us was coming in right around 340 or 350. Remember when I did these numbers? And I said, okay, based on where the monthly payment is, if we just recorrelate that back to, and I can do that real quickly, just to give you guys an example. If we're coming in at the 385, so I'm just grabbing my fancy handy dandy HP 12C calculator. We're coming in at 385 right now. And what's the going rate at the moment?
It's 7.
So, I know it's higher than 7. It's almost 8.
No, the last I saw the national average was 7.02.
All right, we'll just go with 7.
Yeah, I think it's 8% for investor loans right now.
No, well, some of the stuff I look at, it's like 7.7, 7.8, the numbers that I'm looking at for the average. But yeah, if you have really high credit, yeah, then you're back down around that 7. So if you take a 30-year mortgage on that, that's putting the monthly payment at $2,561. So I don't know if you guys can see that. $2,561, right? And that's kind of where around that $2,400 to $2,600 range is where we've been floating at for quite a while in our market. And that's principal and interest only. That doesn't include taxes and insurance. All right. Well, so if you look at that, if we go back to just 3.5%, right? That puts the current value. You want to read that for everyone?
Oh, it's really hard to see it.
It's $570,000.
Yeah. So
if we were still at 3.5% interest rate, we'd be coming in around 550, 570 right now.
So what you're saying is based on the affordability of the home, what the monthly payment would be for the exact same home at a lower interest rate, it would sell for higher.
Yeah, almost $200,000 higher right now than what it is. So
Right.
when I did this was like 6-8 months ago, it was coming in around 470. So it's even gone up another $100,000 since then. And that's what we were seeing for appreciation because our inventory is so low. Now, one thing that could affect this, and it's starting to, is insurance and taxes. That's going to move people. That's the only thing that I can see is moving people's monthly payment down is as insurance goes up and taxes go up. And insurance is skyrocketing right now
Yeah, it is.
across the board. And I'm hearing buyers are getting declined on insurance where they're trying to buy the house. It's been renovated by an investor who's done the renovation on it. And then the buyer can't get the insurance binder because the age of the roof is older than 5 years or 8 years old. So if it's a 9 or 10-year-old roof and it looks great, the insurance companies I'm hearing are already declining those because of the fact that there's been so many storms up here that they know that even though it may not, and the insurance companies are the ones that have been declining the storm damage anyways, but they're saying, yeah, we're not gonna insure it because even though we declined it as a policy, we know it's got damage and it's going to need to be replaced, so we're not going to do it. So
I'm
now
glad you're bringing this up. I want to interject here quickly, Mike, not to throw you off, but this is such an important point that you're bringing up. And I'm going to go off script here a little bit. Not that we script this, but not the market pulse bit. But did you know, and this is for the real estate investors out there that are trying to save some money, that have a little bit of an ability to self-insure. That's who I'm talking to right now. I think this can really benefit you. We're starting to see changes in the insurance industry where you could actually adjust your deductible depending on the damage. So to your point, if your concern is a roof and that's going to make your either non-insurable or a pretty high premium, you could take that, set it aside and say, hey, I'll do a $10,000. I mean, that seems ridiculous for a roof, but a $10,000 wind damage for the roof deductible. Everything else will be my normal $1,000 deductible. And then your premium it could literally cut the premium in half. So, sorry to go on a tangent there, but ask your insurance agent if they're able to set different risks aside with higher deductibles and get that premium where it should be.
And I just did that because and the insurance company I was with, I asked them to do that and they would not do that. So I checked with another insurance broker and they said, well, if we put your deductible for the roof and the siding went up, I don't remember exactly what it was, and then everything else at my normal $1,000 deductible, it brought my insurance policy, because the company I was with went from like $2,800 to $3,600.
Mm-hmm.
And it's due coming up in about a month. So I just started checking for new quotes and I just got a new one. And by doing that, I'm going to be able to get it down to $1,700.
It's amazing.
And
And this is like a new thing. Like, and not all insurance agents, to your point, they're not all doing it. So you definitely will have to shop around, but fairly new. And I just learned this, so I thought it'd be fun to share that with everybody.
Yeah, that's great because I just learned it too, and I didn't even think about sharing it with people. I just got the bid on it about 2 weeks ago, so I'm going to be switching to this new policy because my policy is escrowed. So I'm going to be switching to it next month.
Yeah, fantastic. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
All right, and then back to one of the things you had brought up earlier was, I think that Sean brought up, was the days on market. I'm trying to find that on my screen. Yeah, here we go. So that has come back down to 2.2% from year over year, but it's coming in at 45 days. Right?
So what am I
45
looking at here?
I don't know if you can see this on your screen, everyone. On the right, it's got the month-to-month comparison. And the bar chart has got the year over year.
Yeah, okay. So this is
Over here,
all
it's got
across all price ranges, all product type.
correct, and it's been coming down.
Yeah.
Right, but the 12-month rolling average was 40 days. So we're still above our 12-month rolling average of 40. But that's because last summer it had gotten down to, what's the lowest it got down to? 29 days.
29, 28.
Yep, 29 days. So that's ridiculously low.
Mm-hmm.
But even 45 is really low for days on market, because the historical norm is 90. So that's exactly half of what the historical norm is. So that all these things, and our new listings is now that's starting to come back up.
That's
And
good.
so
That's great.
up 20%. So that is the one thing that can help the market, is if we get more inventory. And I think one of the things is getting to the interest rate part of it. I think a lot of sellers have been holding off on selling because of those low interest rates. But if they're getting, we're getting used to those rates now, and people are like, well, I got to move. Yes, I know my payment's going to go up, but I can afford it, or I have to make the move.
Mm-hmm.
So
Exactly
now we're starting to see more and more inventory, and I am starting to see, for the first time in I don't know how long, price cuts. Not just your oddball price cut, but I'm starting to see a significant number of price cuts. But I do think that is more of the fact that people got greedy. And if they saw, hey, the realtor ran the CMA on it and the comps are coming in at, say, 400, they're trying to say, well, let's just put it on at 425 and see what happens. And so I think that's what we're starting to see right now. I'm not seeing it, if somebody listed at 350 and it's worth at 350. I'm still seeing if they put it at 300, they're getting higher than what they're asking. But I am starting to see, and like I was just driving, we were just out driving in a neighborhood a couple weeks ago, looking at some properties, that's actually about a week ago now, trying to find some comps. Because one of the things I'll do is, when I'm serious about a property and I have to be really honed in on my price, I'll go look at some of the other properties to see, does it look like they've been renovated? And what does the rest of the neighborhood look like, so I can identify, why did the price come in where it came in at? Right, so I was out looking at some of those, and as I was looking at those properties in those neighborhoods, because the comps were telling me that the price was higher than I was comfortable with, and then as I was driving the neighborhoods, I started seeing the for sale and price reduction, for sale, price reduction. So it probably was at the peak for that particular market, but I see that community coming down in price. Those are the other things that you guys have to do, is especially when we're starting to see times like we are right now.
Yeah.
We're questioning, why is the prices so high? Why is the inventory so low? And why is the prices not coming down? Well, we're starting to see some cracks. Another crack
That's
too,
great.
you mentioned, because one of the things I've always told by our investors, the things with the market is, when a market's going to go up in value, what segment of the market goes up first? Condos, then townhomes, then single family. And then the reverse happens. When markets go up, it's the single family, the townhomes, and the condos. When the prices go down, it's the condos first, then the townhomes, and then single family. And you already mentioned that we're seeing, Sean, I think Sean mentioned that we were seeing condos and townhomes are starting to struggle.
Yeah, it's like 75 to 80 days right now on days on market.
So those are the things that we need to keep an eye on. Those are the indicators that it's telling me that single family is going to probably start taking that turn, which is going to be in line with when I was saying earlier that as inflation hits and interest rates start going up, it still takes on average 12 to 24 months for real estate to follow suit. Okay, well, when we're now 2 years in, so we're 24 months or so in, maybe 25, 26. We're a little bit longer than normal, but that we're also not been in a normal market. But we're starting to see the signs that things are changing. So it's time to be cautious.
Yeah, and I gotta throw this out there. There's nothing backing this or behind this at all, but I'm agreeing with what you say, and I don't think that we're going to see any softening at all. Part of the reason is the inventory. I mean, I guess the reason is the inventory issue. But I just read an article that presented an idea that I've never thought of, Mike and Sean, and it was the largest transfer of wealth from like generations is going to be from the baby boomers to the millennials, and I think we all know that, and it's pretty staggering. It's like $350,000 per person with that transfer. And the argument here was, what are they going to do with that money? Well, first of all, that's going to create demand for home buyers because everyone's saying millennials can't afford, right? One, but two, how many second homes is this transfer of wealth going to create? And that's going to be taking inventory off the market. Isn't that interesting?
Mhm.
Yeah, that is. I haven't
Yeah,
thought about that.
I haven't thought about it either. Well, let's. I know we're all busy, especially you, Mike. So let's go through the months of inventory because I love that statistic. I think that gives you the most clear picture of where the market is. So maybe you could tell us your
Uh,
opinion on looking at a month of inventory, or yeah, a month of inventory, and then let's go through the statistics. And then I don't know if Sean, if you have any questions for Mike before get him out of here, but I like to go through the months of inventory if we could.
there it is. Month supply of inventory it's up from year over year to 17.6 because we are getting a little bit more inventory in the market.
Yeah, so for the listener, it's
6%
17.6%
increase,
increase. It's still 2, which
2
is
months.
still like it, it could double before. It would have to double and even then some before it would be considered neutral. Yes?
Correct, because anything below 4 months is a seller's market.
That's why you're seeing the prices go up.
Right.
This right here is why.
And all these other factors. So, like Kevin, and I agree with you 100%, Kevin. We're going to see a softening of the market, but not a crash in the market.
Okay. Yeah, I would like to hear your opinion on that.
Yeah, exactly. That's exactly what I expect to see is a softening of the market. I don't see it crashing. I just don't see. I see it starting to stabilize,
Okay,
and the
and that's
prices.
because of what you said about the townhome, softening in the townhome, or the increase in days of on market.
Well, the townhomes and the condos, the biggest problem I think we're going to see there is because of partly because of the storm damages, but the insurance that we are just talking about. I was just talking to another guy that his annual insurance premium for their association because he's on the board was coming in around $150,000 a year. It just jumped to $900,000. So, in order for them to renew their insurance policy for the association,
Yeah.
it went from 150 to 900. So they have to increase everybody's HOA fees to cover that.
Where is that?
That was here locally
What's the risk they're trying to protect? So here's what's
because of the
going
storm
on. We're
damage.
absorbing all of the risk in California with the fires and Florida for the floods.
And here in Minnesota for all the storm damages that we've been getting.
Okay.
Because when when the
Nine.
storms come through, it does a lot of damage to the exteriors of the properties. And when you think about condos and townhomes, what are they insuring? The exterior of the property. They're not covering the interior, they're only covering the exterior.
Mhm.
But their policy now he's in a big association.
Yeah, it must
Because you
be.
think about $150,000 annual insurance premium just for the exterior and common areas of the association for the townhomes, jumping from 150 to 900. So that is probably what we're seeing causing the prices of the condos and the townhomes coming down is because the
Yeah,
HOAs are going up.
that makes sense.
Right.
It's
But
crazy.
now we have this new lender at Minria, and he's like in between the hard money lenders and the traditional lenders, and he does a lot of commercial stuff and oddball stuff. And he was sharing a story the other day where he has just recently insured, I think he said 3 or 4 condos in these associations where the associations were under litigation and they were still able to get, because that's the other issue is if they're under litigation. Well, I think we're going to start seeing a lot more litigation again because of these HOAs going on.
Yeah, and if the condo's in litigation, it's considered non-warrantable. So here's another quick lesson for you investors out there. If you're going after deals and things that will cash flow, this is an opportunity. So if what Mike's saying is accurate, which I have no reason to doubt, when it goes into litigation, that's a great buying opportunity because it takes an owner-occupied buyer almost completely out of the market.
Yeah,
Because now
well,
it's just harder to finance. You have to have creative ways to finance it because non-warrantable is not going to be FHA or Fannie Mae approved.
okay. So what you're saying is true. There's going to be a window of opportunity for investors, but that window is very, very small because your average association is going to have a limit on how many can be sold on contract for deeds or lease options or rented out. And if they're not at that capacity now, it only takes 2 or 3 or 4 deal transactions to hit those limits. Now you got a whole segment of buyers or sellers in these associations that didn't sell already are going to be struggling to sell.
Yeah, so maybe it's more of a cash buyer opportunity, someone who doesn't need to bring in any financing, and then wait till the litigation is settled, and then you'll see a pop in value.
Well, I think where the real opportunities come in is either cash or
Yeah,
subject to situations. But now,
that's another
what are
great
you
point.
walking into? That's the scary part. But on the flip side, when the markets crash, the best ones to get into is condos and townhomes because by then the associations have gone through all that litigation. They've struggled so much they've had to completely change their bylaws in order to fill those properties to bring in the revenue that they need to support the association. That
Yeah.
they start loosening up their requirements, and it becomes easier for investors to come in because
Yeah,
we
and I
can
should
have
say
the rental
this, what
properties.
based on what you're saying makes me want to say this because you need to go in with your eyes open, you guys, if you're going after litigation, HOA litigation properties, because there's obviously risk. What if they lose, or what if it's a big settlement and there's a big special assessment to the owners and they have to pay out? So what I said is true, and be very, very careful.
And when you see the market, if our markets go down and a couple of years from now, and you see the markets turn around, condos and townhomes are great opportunities to get into at
Agreed.
that time.
I
Yep.
agree. Okay, so anything, Sean? You got anything for Mike?
Well, the only thing that was popping into my head was the conversation that we had in our office a couple weeks ago. Was everything to do with the NAR settlement that came about? Was that
Yep.
towards the end of April that came about, or middle of April? I was just curious if Mike had any insight on that, and if he thought it was going to, affect the market around here, or how it would affect the market.
Um, I yeah, I do have an opinion on it. My opinion is contrary to most people believes. I believe it's actually going to help increase the value of real estate, and it's going to drive out a lot of realtors out of the industry.
Okay, so
That doesn't mean it's
that's
going
true.
to.
Yeah, help us understand that. Unpackage that for us.
So the bottom line is with the settlement, the part of the settlement that affects it, the real estate community is in general is about 30, 40 years ago. I don't remember exactly when it started. It became common practice for the listing agent to negotiate the entire commission for the buyer's agent and the seller's agent. And then in order to advertise your property on the MLS, and that's what made it common or standard for the listing agent to pre-negotiate the full commission for both buyer and seller side of it, was in order to be on the MLS, you had to display and share with the buyer's agent what the commission percentage is that you're going to be giving up. So if you got a 6% commission agreed upon with the seller, how much of that was going to the buyer's agent?
Yep.
Going to be 2.7, which is the norm around here in our area, had been 2.7 to 3% on your residential transactions. So the buyer knew coming in what they were going to make off the transaction. So the basis of the lawsuit, which they've been bringing this over and over and over again for years, was that the because it's advertised to the agents are now steering the buyers to different properties based on what the non-public commission was for the buyer's agent. So that was the argument of it. Now, as a broker and working with brokers and with and realtors all over the state, and actually all over the country, I've never seen a buyer make a decision based on what the commission was. They make a decision based on what they're going to show, based on what their buyers can afford. And now they may, if there's a significant difference, which you rarely ever saw, but if there was one, that might influence them a little bit more to try to steer them towards it. Say if they're asking for opinion and their decision was between one or the other. Okay, maybe in a real small percentage. But that's where that's what brought the case in the first place, is because it was unfair to the buyers. Well, now that they've settled, what NAR has agreed to is like, all right, the listing agent doesn't have to even, we don't have to display it. We're no longer displayed on the MLS. So as of July, I think it's July 1st is when it goes into effect. It's either June 1st or July 1st. I can't remember
Yeah, I think the deadline is August 17th, but NAR has committed to have it all rolled out by the end of July.
End of July is what. Okay, so by the end of July, they're going to, or by whatever the date is that they have to have it done by the middle of August, they're no longer going to display what the buyer's broker's commission is. So the listing agents will not have to negotiate on the seller side, on the buyer side. All they have to say is, hey, I want 3% commission. And they just tell the seller, look, we're going to charge you 3% commission. Well, where's the buyers going to get their commission from? Well, the buyers are now going to have to negotiate that with the buyer's agent. And the buyer's agent then has the ability to go back and ask the seller to negotiate that for them. But that's going to make it harder and harder for the buyers to do the negotiations. And that's going to be less incentive for the buyer's agents to want to do that. They're already going out and showing 100 properties to some of these buyers. And now there's no guarantee that they're even going to get a commission on it. What's going to be their incentive? So I think we're going to start seeing less and less buyer's agents and more listing agents. And the listing agents are going to like Redfin is a listing agent. Right? Redfin was one of the big ones that brought this case on, and they've already came out in public and said, this is great news for us. He says, because now we don't have to pre-negotiate it for the buyers, so we're not going to. Let the buyers can figure out how they're going to get paid on their own. And what they were saying is, what I think is going to happen is the buyers and the buyer brokers are going to be under buyer broker agreements. So I think you're going to start seeing more and more buyer broker agreements. Well, I think what you're going to see happen from that is over time, and so you might get a few people do that in the beginning, but over time, the buyer's agent, the buyers themselves are just going to start going directly to the seller's agent.
Yeah, there's listing agents once again will have to work.
Yes, and they're going to have to do the buyer's work.
Yeah.
So it's going to get back to where it was pre-MLS.
So why do you help me understand? So for the listener, there was a lot of information there. So basically the change is the buyer's agent has to negotiate directly with the buyer and have an agreement in place for what the commission is going to be. It does not say anywhere in the settlement where that commission is going to come from or how much it can be. It just has to be either a defined amount or a defined way to calculate the amount. Okay, so we're still going to see sellers paying these, in my opinion. It's not going to really change that. The only thing I think is going to change is how it's advertised.
No,
and FHA agrees with me because FHA has announced already, and it hasn't even been rolled out yet, that they are not going to count seller paid buyer's agent commission, say that 3 times. They're not going to count that as part of the 6% allowable concessions. So even though it's a concession, it's not going to be counted as a concession when qualifying for the loan. So help me understand how this is going to impact real estate values.
It won't impact values. It's going to impact compensation.
That's true. Okay, I thought maybe I misunderstood you. I thought you said it might increase or put pressure on the values of real estate values.
Well, okay. Yeah, I have thought about this too, and I think it might, because if we can't add, now I didn't know about FHA, so that might change that, doing that. But so if it didn't, the prices are going to have to come down a little bit more. Or not going to have to come down. It's just if they're trying to negotiate that, prices are going to have to come down to compensate for that because the buyers are going to start paying them. And I just, believe it or not, I just sold a property on a contract for deed. In fact, I sold it last week. We're going to go to closing later this week, where the agent brought it. So I'm not it's not listed on MLS. I'm selling it outright. And the agent brought a buyer and he says, I have a buyer for your property because I'm offering on a contract for deed. So basically, I'm the bank for them. And they said, I have a buyer for it. And I'm like, the numbers are too thin on this one. I can't pay a commission. He said, don't worry, the buyer's already paying it. I'm like, all right. So I didn't even do a listing agreement or nothing. They just sent the buyer to me, and they've already got the buyer under a buyer's broker agreement, and the buyer is paying them. And when I was talking to the buyer, I'm like, and how are you paying your agent? Because I know there's an agent involved. He says, yeah, I'm going to have to cover that. But what it did do is affected what I could get from a down payment from the buyer.
Beautiful. So do you mind disclosing what the amount of that commission was?
Uh,
Or do you even know?
I think it was only 1%.
Yeah, that's my point. So I do think that we're going to see buyer's agent commission come way, way down. So where it was 2.7 to 3%, to your point, it might be 1% now. But they're not going to be working as hard, right? Because they're not going to be opening up doors. So it's probably fair.
But now here's the flip side of this, Kevin. I also heard Fannie Mae and Freddie Mac have already started talks to add the buyer's commission on top of the loan. So the loan, what I'm hearing is that the loan, no, this is not FHA, this is Fannie Mae, Freddie Mac, that they're already in talks. It's nothing been approved. It's in talks to where they're going to include that to the loan. So whatever they approved for, they're going to add that 2 or 3% or whatever it ends up being on top of the buyer's loan, and they're going to finance that over 30 years.
Yeah, that's basically what FHA has already said they were going to do. So it's just following suit. The interesting one is VA, because VA specifically does not allow the veteran to pay their commission. So they would be denied for the loan if they're agreeing to pay a commission. So we'll see what VA does. But if you have FHA and Fannie and Freddie, as you're saying, on board and accepting this, I just don't see it affecting the market that much. What it will do is help us investors, because on our flips, we'll probably get a higher net amount because the commissions are lower. But the value of the house, I just don't see how it actually moves up or down unless we lose buyers to the buyer pool. If buyers freak out and say, I'm not paying a commission, I'm not doing it, and they don't understand that they can negotiate it into the deal, they might exit.
I think where it's going to happen is they're going to start going directly to the seller's agent.
Yeah, I don't think we lose a buyer. I mean, we might lose some. Here's what might happen. They might get hurt because they have no representation. So we're doing this to help buyers, and I think what might end up happening is them getting hurt.
Well, here's my cynical view. Where was the representation before?
Yeah. I mean, that's a lot to unpack with that one.
Yeah, that's another part.
That's a whole other episode.
That's the next podcast. All right, cool. Anything else?
Well, I guess we can safely say none of us really know. We're just speculating what's going to happen right now.
I'm fascinated by this settlement because everyone has their own opinions, right? So we'll see.
Well, we haven't had time. We haven't had time to see the actual effect and how are the buyers going to react to this.
That's right.
And how are the agents? It's actually more about how the agents are going to react to this.
100% agree. Specifically, the buyer's agents, right?
Yes.
But yes, it's how do you, as a buyer's agent, adapt? I actually think if you're nimble and creative, it'll probably benefit you. You'll be working more behind the desk instead of out in the field, but I think you can make more money, honestly.
But there'll be fewer agents to be able to do that.
Totally. And that's right. And that's why I think you can make more, because there'll be less people doing it, and you could do way more volume because you're not in your car.
Well, and I see companies like Zillow, Redfin, and those guys growing and becoming even bigger now because of it.
That's a good point. Yep. Yeah, all these different things to consider. Be very interesting.
Yeah, let's revisit this one in about a year from now.
Yeah, let's do it.
Yeah, it's been reacting.
It'll take about that long for it to actually show on how it's turning out, too.
Yeah, it will, definitely.
That's right. All right, Mike. Well, here's what I got out of this amazing Market Pulse podcast on the Real Estate Educators podcast. there's really nothing to worry about. Not a lot has changed in the last quarter. We still have super low days on market. We're looking at it right now, 2 months, which is pretty staggering how low that is. And that's why you're seeing the price pressure. So we're still seeing median values increase. Now, Mike did say maybe we'll see some softening. He's starting to see that because of insurance costs in the attached housing product. And that's typically a leading indicator. So that's something we should keep an eye on. But overall, no crash, pretty stable. Minneapolis is a great place to buy. So despite that survey, I think it was actually a Fannie Mae survey, 76% of people think it's not a good time to buy. Despite that, we do not agree, especially in your area, especially in Minneapolis. How'd I do? Is that pretty much sums it up?
Yeah, I would say so.
Yeah, I'd say so too.
Mike, thank you so much for your time
welcome.
today. I know you're super busy, and as always, we really, really are gracious for you coming on and educating us and helping us understand the market in your backyard, something that you follow very, very closely. And to the listener, thank you so much for tuning in. If you haven't yet, give us a 5-star review. That's the only way we can improve the podcast and help more real estate investors just like you. So with that, I hope you make this day a great one. See you later, guys. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.